Nvidia sells you the chips, helps you borrow to buy them, takes a stake in you, and covers a quarter of the lender's loss if you default. 6 Wall Street giants just signed to move $500 billion that way. Is this infrastructure finance or a Ponzi built on melting collateral? We verified every number from August 18th. Verified, on August 10th, 2026, Nvidia signed Memoranda of Understanding with 6 firms, Apollo, Blackstone, BlackRock, Brookfield, KKR, and Goldman Sachs as lead bookrunner. Target is around $500 billion of third-party capital, not Nvidia money, for AI compute. These are umbrella targets, not committed capital. Each institution keeps full discretion, no capital drawn yet, and Nvidia does not originate loans. Jensen Huang told CNBC August 10, "This is really the first time that technology chips have become an investable asset class. They are revenue-generating, productive, long-lived, fungible, redeployable." Blackstone's John Gray compared it to mortgage lending. BlackRock's Larry Fink called it the next mortgage-backed era. That's the pitch. GPUs treated like toll roads because they can be reused by another customer if one defaults. Verified and critical. The structure is called residual value support. If a GPU cluster is worth less than the model at the end, Nvidia covers part of the shortfall. Cap is up to 25% of an individual facility, assessed case by case. At a flat 25% of 500 billion, that is 125 billion of potential exposure, but Nvidia stresses it is supplementary, not replacing independent underwriting. Verified. Nvidia is shareholder, supplier and buyer of last resort at the same time. It holds about 13% of CoreWeave after a $2 billion injection January 2026 and has a $6.3 billion master services agreement to absorb CoreWeave's unsold capacity through April 2032. Lambda secured a $1 billion GPU collateral facility in May 2026 under a framework built with Nvidia support. Reports of a $3.5 billion Apollo debt for XAI are unverified. Verified. Lenders put up 50 to 70% of cluster value, less for newer hardware. H100 65 to 70%, Blackwell B200 60 to 65%. Spot rental collapsed, verified. H100 from $8 to $10 per hour in 2023 to 1.80 to 3.50 in Q2 2026, budget providers under $1. Used H100s from 30K to 40K peak to 8K to 22K now. GPUs booked to depreciate over 4 to 6 years, but economically competitive only 2 to 3 years, may lose 30 to 40% in year 1, pushing negative equity in 12 months. Verified. The defense that lenders underwrite the customer, not the chip, is partly true. CoreWeave has a meta-backed facility. Moody's rates A3 at 5.9% and 129 billion contracted backlog, but riskiest tranches demand 14 to 17%. Customer contracts average 3 years while debt lasts 5. Late July, the SEC issued guidance that many data center financings are not asset-backed securities, so they sit outside post-2008 5% risk retention rules. Originators can sell 100% and walk away, typically to insurers and pension funds. Verified. Bank of England. July 7th Financial Stability Report warned AI correction could knock 2.2% off UK GDP. Private credit is now 2.2 trillion with a fifth touching AI. Historical parallel to Lucent is directionally correct. Lucent vendor financed 8.4 billion, then wrote off 7.5 billion and market cap collapsed, though Nvidia's structure is capped support, not direct lending. CoreWeave debt verified 35.6 billion total debt. Interest 267 million to 640 million in 4 quarters, net loss 626 million. Nvidia CDS doubling and CoreWeave 855 basis points are reported but not independently verified. Final verdict. The 500 billion MOU, 25% backstop circular CoreWeave structure, rental collapse and risk shift to pensions are verified. Calling it a Ponzi is provocative, but the structure is Ponzi-like. Debt stacked on depreciating collateral that only looks safe if demand never slows.